The ugly rotation continues. Investors are cautious about inflation, interest rates, taxes, and the pandemic situation in other nations. Some are worried that the economy is recovering too fast. Others argue that the stay-at-home play is over. All of this is pushing recovery stocks higher and growth is in check. As an investor, what should be your moves? Let's chat. Hey guys, welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, and everything money. After a stunning 2020, tech is in check this year. While Dow and S&P are on a tear, growth stocks are getting hit hard. In this video, I'll share my understanding of the market and changes I've made to manage the short-term market sentiment. Since the March 2020 lows, equity markets have come back huge. Growth and high beta names dominated the market as work from home became the new normal. Housing took off as people decided to move into bigger, better houses. Record low interest rates played a major catalyst. Financials, retail, travel, airlines, cruise lines, and entertainment took a hit while anything work from home prospered. Recession came and went, and since the lows, we entered the new bull market. We closed 2020 with S&P over 50% and Nasdaq up 70% from the March lows. The narrative for 2020 is a bit different. Want to say mixed. Vaccines are out, housing continues to roll, jobs are coming back, and economic growth is super hot. This has led investors to flee the 2020 high flyers and move into financials, energy, and reopening stocks. We are seeing a major rotation out of tech. Here's the bottom line. US is getting vaccinated and economy is red hot. Inflation, higher interest rates, and taxes is now a concern. This is reflected in the stock market as we are seeing outflow from tech and inflow into reopening, financials, and energy stocks. I think the next quarter or two, the trend will continue. Some of the work from home plays are really stretched. While I'm bullish long term, I do see high beta stocks to be under pressure in the short term. With that said, here's a quick update on my portfolio year to date. 40% is in mix of dividend and growth stocks, more tilted towards growth. ARK Invest ETFs make 20% and 40% is in leveraged ETFs. As of April 30th, my portfolio is up 12%. Pretty decent given how Nasdaq has performed compared to Dow and the S&P. Here are some of the adjustments I've made to my portfolio starting May to manage the changing tone of the market. Basically, moving money from non-core positions into core positions. Core positions are the ones where I am in for the long haul. Non-core, on the other hand, are in areas which offer short to medium-term opportunities. I've not added any new money since my buy thresholds have not been hit. Instead, made adjustments on how money is allocated. Update number 1. I liquidated all my cloud stocks and leveraged DTN Fengu. Between the two, it was around 5% of my portfolio. I do think the work from home trend is here to stay, and 2020 offered a huge opportunity in this space. However, some of the cloud names were massively stretched. I took profit on these and used the proceeds to buy the dips in my core positions. I still like the space, but will play this via ARK ETFs, which is one of my core holdings. I love the stocks Fengu tracks, and except for Twitter and Alibaba, I hold the other stocks. However, I don't think the current environment is right for high beta names. I continue to hold the actual stocks since they are what I call as core, but have decided not to go leveraged with Fengu. Update number 2. I trimmed a bit and locked some profit in UW. It is now 4% down from 5.5% of my portfolio. With all the reopening talks, Dove has been on a tear. As the economy continues to get back on track, Dove will prosper, which means UW will prosper. That said, UW is not my core holding, but more a way to play the current tone in the market. I intend to stay in UW in the short to medium term and will eventually move profits and the entire allocation into my core holdings. Update number 3. So where did I move the proceeds? Again, into my core holdings. I took 80% and spread it evenly between TQQQ, SOXL, UPRO, and FEZ. Tech earnings have been stellar, led by FANG-M, minus Netflix. However, stocks are down. It only means an opportunity to buy them low. TQQQ is a leveraged way to play tech. SOXL, similar story. Semis have been a market leader for a while now. The Biden administration is favorable for this sector, and then of course we are dealing with the chip shortage. Again, opportunity to buy low and bring my dollar cost average down. In a confused market, investing in the S&P 500 is your best and safest bet. Indeed, my partner Warren will agree. UPRO tracks the S&P 500 and is my largest holding across my portfolios. Finally, FEZ. As interest rate talks continue, and at some point they will go up, financial sector will benefit. FEZ is the leverage play for financial sector ETF XLF. I consider it non-core. I prefer actual stocks like Bank of America and JP Morgan, which I hold. I intend to play this in the short to medium term and will eventually sell out of it, hopefully with profits. Finally, I used the remaining 20% and bought the dip in Airbnb, Tesla, Baidu, Netflix, AMD, and opened a new position in Crown Castle. Here is what my allocation looks like now. Okay, so those are my updates. Looking at how the market is shaping up, feels like I played my cards right, at least for now, but we'll see. By the way, I have a link in the description to my entire portfolio on M1 if you care. I do make an effort to keep it up to date. Also, I have a referral link if you want to open a new account on the M1 Finance platform. We both get some cash to invest. Thoughts, comments? Let me know how you're managing the market these days. Hit the like button if this was helpful. Until next time, peace.